All right, welcome everyone to this evening's webinar. It is my pleasure to introduce our speaker. Um, and so I'll go ahead and do that now. Kristen, if you want to say hi, she's on the upper left-hand screen on my window. So
Hello.
Kristen Anderson is a partner of the law firm for nonprofits and contributing author to CEB's Advising California Nonprofit Corporations. Her passion for working with nonprofit organizations began at a young age. Kristen was drawn to the law firm for nonprofits so that she could make assisting nonprofit organization her life's work. Kristen has a BS in mathematics and a minor in law and society from the University of California, San Diego. She attended University of San Diego School of Law, where she earned both a JD and an LLM in taxation law. Kristen is a member of the State Bar of California and a certified legal specialist in taxation law. During and after law school, Kristen worked with the University of San Diego's legal clinics and the San Diego Volunteer Lawyer Program to provide pro bono legal services to clients in need, earning a Distinguished Service Award for her outstanding contributions of legal services and recognition by the State Bar of California for voluntary provision of legal services to the disadvantaged, improving the law and the legal system, and increasing access to justice. Kristen enjoys working with nonprofit organizations on complex tax matters, as well as advising nonprofit boards with regard to ongoing compliance with both federal and state laws. She frequently provides educational presentations on nonprofit compliance and legal and ethical responsibilities of board members. And with that, Kristen, I invite you to share your presentation and take the floor.
Thank you, Jody. I'm going to share the presentation that I have, hopefully.
Oh, you're on mute and we can see it.
Sorry about that. I forgot that I was automatically muted. Thank you all for having me tonight. As Jody mentioned, I enjoy giving educational presentations to nonprofits. So tonight, hopefully, you will also enjoy the presentation that I have for you. Our firm is the law firm for nonprofits, and all of our clients are nonprofits and tax-exempt organizations. So we specialize in providing services to nonprofits. Anywhere from forming nonprofits to advising on complex business transactions, complex tax matters, mergers, acquisitions, all the way down to dissolutions. So we are purely a transactional law firm. We purely provide legal services to nonprofit organizations. So tonight's presentation is going to focus on corporate governance and tax matters as they relate to yacht clubs and related 501(c)(3) organizations. So I want to start the presentation with just a brief discussion of nonprofit terminology and explain what I am talking about when I say a nonprofit or what I am talking about when I say a tax-exempt organization. So the concept of a nonprofit essentially just means it's any entity that is not organized for profit. That means that the organization cannot distribute its net earnings to any individuals who exercise control over it. That doesn't necessarily mean that it cannot profit. Nonprofits are certainly profitable and should be profitable, but those profits have to be reinvested in the organization and used to further the organization's purposes, as opposed to distributed to owners or shareholders, which nonprofits do not have. In California, there are two different types of nonprofit corporations that are relevant for the presentation tonight. There is a third. I won't be discussing it because it is not relevant. But the two that we're going to be discussing tonight are California nonprofit public benefit corporations and nonprofit mutual benefit corporations. So public benefit corporations are, as it implies, there to benefit the public. Those are typically charitable organizations or educational organizations, organizations that are typically exempt as 501(c)(3)s. And then the mutual benefit corporations are intended to benefit the members of the organization or a mutual purpose that the members or individuals that are related to the organization engage in. So that would be similar to a social club or the yacht club organizations that are 501(c)(7)s. So under the umbrella of a nonprofit is also the idea of a tax-exempt organization. So a nonprofit in and of itself is not tax-exempt. You have to qualify for tax-exempt status. Some tax-exempt statuses are automatic if you qualify. Some you have to affirmatively apply for. So the two different types of tax-exempt statuses that we are going to be concerned about tonight are the 501(c)(3), and that's the charitable, religious, educational, scientific, etc. purposes. I say etc. because there is quite a long list. And then there's the 501(c)(7) social clubs, and those are clubs that are organized for pleasure, recreation, and other non-profitable purposes. So 501(c)(3) organizations are further classified as either public charities or private foundations. We won't discuss private foundations tonight because that's not relevant to the presentation. Public charities are those organizations that are essentially supported by the general public, and there's a specific public support test that the organization has to satisfy in order to be considered a public charity. And there is a benefit to be classified as a public charity because there are additional restrictions that apply to private foundations because private foundations are funded by one or a small group of individuals. And so there's more concern that those funds might be used inappropriately than when you're dealing with a public charity where a majority of the funds come from the general public or from government grants or from foundational grants. So the type of 501(c)(3) organization that we're going to be talking about tonight is our public charities. So nonprofit organizations are subject to several bodies of law, which is what makes nonprofit law complicated and is also what keeps me employed. So we have exempt organization tax law. So that's federal income tax. That is the Internal Revenue Code. That's where you get your 501(c)(3) status or your 501(c)(7) status. We have state income tax in California because we have state income tax. If you want to avoid state income tax on your organization, that is a separate exemption that you have to apply for. There's state property tax, state sales and use tax. There is no automatic exemption from property tax or sales and use tax for nonprofit organizations. Some charitable and religious organizations can qualify for state property tax, but it has. It looks like I got automatically muted again. Okay. So what I was saying was property tax may be available to some charitable or religious organizations, but you have to affirmatively apply for that exemption. There's also nonprofit corporation law. So that's the California Nonprofit Corporation Law. It's what you file under to get your public benefit or mutual benefit status as a corporation. We'll get into more details about the corporation law when we talk about corporate governance. There's charitable trust law. So if the organization is going to hold or solicit assets for charitable purposes, whether or not it's a 501(c)(3), it is required to follow charitable trust laws with regards to investing, managing, holding, and using charitable assets. And then there's fundraising law. So again, regardless of whether or not the organization is a 501(c)(3), if the organization is going to be soliciting donations for charitable purposes, it is required to follow fundraising law rules and regulations. And we will discuss what those are as well. So we're going to start with corporate governance. So all nonprofit organizations formed in California are legally required to have a board of directors. The board of directors is the governing body, and all the activities and the affairs of the corporation are conducted by and overseen under the direction of the board. The board can certainly delegate the management of the activities of the organization, and often does. If the organization has staff or if the organization has officers, then the board may delegate some of those responsibilities to the staff or the officers. But ultimately, it's important to understand and be aware that the board is ultimately responsible for the organization. So in delegating that authority, the board needs to maintain oversight and ensure that it does not over-delegate authority, because it may ultimately be held responsible for the actions taken by those that it delegates authority to. So also, in addition to the board of directors, there are also officers that are statutorily required under California law. Every nonprofit corporation is required to have a president and or a chair. So you can have both, or you can have one or the other. They're required to have a treasurer, and they're required to have a secretary. This applies both to public benefit and mutual benefit corporations. Where there is a difference is who may serve in those positions. So under the mutual benefit corporation law, any number of offices may be held by the same person unless the bylaws or the articles state otherwise. So that means you only have to have one person that is the officer. They can be the president, the secretary, and the treasurer. And that is legally permissible for a mutual benefit corporation. For a public benefit corporation, there's more checks and balances, and it requires that the president or chair position be held by a different person than the secretary and treasurer positions. So this means that you are required to have a minimum of 2 officers, one to serve as the chair or the president, and one that can serve as the treasurer and the secretary. Now, most of the time, there are 3 separate people that serve in each of these positions, or 4 if you have a president and a chair. These are just the limitations that come into play when you're starting a new organization and maybe you have 1 founder or 2 founders and you don't have as many people that are willing to serve in those roles as the organization gets up and running. In addition to statutory officers, you can have any number of other officers that the board wants to appoint. You can have a CEO, a CFO, assistant secretaries, assistant treasurers, vice chairs, vice presidents, any number of additional officers that the board determines may be appropriate for the organization's operations. Another area of corporate governance that's extremely important, especially when it comes to 501c7 organizations, are the members. So in California, there are both membership organizations and there are non-membership organizations. And both mutual benefit corporations and public benefit corporations can be either member organizations or non-member organizations. Most of the time, public benefit corporations are non-member organizations, and most of the time, mutual benefit corporations are member organizations. So what a member is a legal term that is defined under the Corporations Code, and essentially what it means, it's a person that either has the right to vote on the election of directors, dissolution, merger, or disposition of substantially all of the corporation's assets, or that is designated as a member in the articles or bylaws of the organization and has the ability to vote on changes to those articles or bylaws. So any individual that is deemed to be a member under the organization's bylaws has the statutory rights provided to that member. And I'm going to go through what these rights are on the next slide. I just want to make a note here that members do have enforceable rights. And membership organizations tend to be subject to certain administrative burdens because of those rights. So when we advise organizations on whether or not they want to form as a membership organization or non-membership organization, we go over all of these burdens in detail, the additional expenses that they might have to engage in, the checks and balances of authorities and rights that each of these classes of individuals are given to make sure that they truly want a membership and that it makes sense for their organization. Now, for a 501c7 social club, a membership is certainly required, so you wouldn't have that determination on whether or not you can be or cannot be a membership organization. But for 501c3s, it is not required. So those types of organizations typically want to think long and hard before they decide to add members into the mix, creating additional burdens on the organization. So actions requiring member approval are many, as you can see, and this is what creates that administrative burden and creates additional costs and expense and time-consuming actions of the organization. So members, of course, get to vote on the election of directors, removal of directors, and filling vacancies created by that removal. They also get to vote on any amendments to bylaws or articles that may materially or adversely affect their voting rights. So that would be an amendment removing their ability to elect directors, for example. They get to vote on certain amendments to the bylaws, such as changing the number of directors, changing the term of directors, increasing the quorum requirement to conduct a membership meeting. And members, of course, get to approve any amendments that would terminate their rights as a member. So terminating the membership as a whole, for example. In addition to all of that, they also get to approve transactions that involve substantially all or all of the corporation's assets. So that's defined as 75% or more of the corporation's assets. So for example, if your nonprofit organization owns a piece of real property and the real property is about 75% or more of the value of the organization's total assets, it would require membership approval to do anything to that property, whether it's sell it, lease it, dispose of it, whatever it is, it would require membership approval to engage in that type of a transaction. And then entering into agreements of merger or dissolving the organization. So if the organization wanted to merge with another organization or cease its operations and dissolve, those types of actions also require the approval of the members. All right. So going back to the board of directors, I want to focus a little bit on director fiduciary duty. This was a topic that a lot of individuals had questions about, and so I want to make sure it is addressed properly and completely to make sure that everyone on the call understands what this means to be a director of a nonprofit organization. So under both California nonprofit public benefit corporation law and mutual benefit corporation law, there is a statutory fiduciary duty that is imposed upon directors of a nonprofit corporation. So that statutory fiduciary duty is described here, and I will explain what each of these things mean and provide examples. Essentially, what it is saying is that every director must act in good faith in a manner that that director believes in the best interest of the organization and with such care, including reasonable inquiry, as an ordinarily prudent person in a like position would use under similar circumstances. So what this breaks down to is a duty of care, a duty of loyalty, and a duty of obedience. So the duty of care essentially is exercising good judgment and prudence and acting in good faith and in the best interests of the organization. The duty of loyalty is focused on advancing the mission and interests of the organization and always ensuring that the organization comes first, not yourself or any other organization or any other individual. And then the duty of obedience is essentially ensuring that you follow the law, the bylaws of the organization, and any of the organization's internal policies and procedures. So duty of care. What are some common ways that you can breach your duty of care? As I mentioned earlier, the board can delegate responsibility for management of the corporation. The easiest ways to breach your fiduciary duty of care is to over-delegate that authority or fail to supervise that delegated authority. So those are very common ways that you can breach your duty of care. And then another very common way that we see directors breach their duty of care is making decisions without sufficient information or due diligence. So in order to ensure that you satisfy this fiduciary duty, you want to make sure you attend meetings and not just attend meetings, but actually be present, listen, input your experience and background where necessary to help others understand and make decisions as well. Using your independent judgment, so not rubber stamping decisions or relying on other people's decisions to make your own. Make sure you have all relevant information and to diligently review and consider all of the materials that are provided to you. Ask questions, delegate authority carefully, and make sure you oversee that delegated authority. So those are all ways that you can ensure that you satisfy your duty of care as the director of a nonprofit corporation. The duty of loyalty. So the most common ways that we see individuals breach their duty of loyalty are one, seizing corporate opportunity or competing with the organization. So as I mentioned previously, the organization always comes first, not yourself or not any other entity. So if there is an opportunity that you are interested in, but it is also an opportunity that is presented to the nonprofit has to come first. You cannot seize that opportunity away from the nonprofit. Probably the most common breach of duty of loyalty we see is disclosing or using confidential information. So remember, any information that is shared at a board meeting that is not publicly available or otherwise available to anyone outside of that meeting is confidential and should not be shared or disclosed outside of that meeting. Using the organization's property or assets for personal benefit. This is also a very common one. You can't use your position as a director in a nonprofit to gain an advantage or to get a benefit. So that's a very common breach of duty of loyalty as well. And then also having inappropriate or undisclosed conflict of interest. So we'll talk a little bit about conflicts of interest here in a little bit, but essentially all organizations should have a conflict of interest policy, and directors and officers should be disclosing any potential conflicts of interest on an annual basis at a minimum. So you can satisfy your duty of loyalty by being fair and impartial, always placing the interests of the nonprofit ahead of your own, making sure you disclose any conflicts of interest, corporate opportunities, or personal interests, and then, of course, refrain from making special requests of the organization or otherwise using your position in the organization to get a benefit or an advantage. And then the last, duty of obedience. So essentially acting in any way that might be detrimental or inconsistent with the purposes or goals of the organization, using charitable assets for others purposes other than the nonprofit's mission or tax-exempt purpose, and authorizing actions that could jeopardize the tax-exempt status of the organization. And we have lots of slides towards the end of the presentation talking about maintaining your tax-exempt status and ways that you can jeopardize or lose your tax-exempt status. So to satisfy your duty of obedience, be aware of and meet all filing obligations. So ignorance of the law is not a justification for not following the law, so make sure you're aware of what your filing requirements are and adhere to them. Ensure you're complying with your organization's mission, complying with any internal or external laws that are imposed on the organization. We'll go through a lot of those today as well. And then always using charitable assets to further the mission of the organization. And that one is specific to 501c3 charitable organizations. So in satisfying your fiduciary duties as a director of the organization, the law allows you to rely on experts. So you're not expected to be an expert on everything nonprofit law or everything tax-exempt organization law. So you can rely on your officers and employees if you believe that they're reasonably reliable and competent with regard to the matters that they are advising you on. You can, of course, rely on attorneys, accountants, or other professionals that provide you with advice in their area of expertise. And then you can rely, of course, on a committee. So whether it's a committee of a board or an advisory committee, as long as that committee has the relevant expertise needed to advise on that subject. So for example, if you form a fundraising committee and you populate the committee with individuals who have experience in fundraising, you can rely on their advice with regard to fundraising to the extent that you feel that, that their knowledge is reliable. In addition to relying on the opinions of experts, another way to make sure you satisfy your fiduciary duties, of course, is not engaging in conflicts of interest. So in California, we have this concept called self-dealing, and this is a concept that is specific to public benefit corporations. This concept can be applicable to mutual benefit corporations if the mutual benefit corporation holds any assets in charitable trust. So like I said above, if a mutual benefit corporation fundraises for charitable purposes or otherwise hold assets for charitable purposes, then these provisions would apply to the mutual benefit corporation. But if it does not, then these are not applicable. So essentially what a self-dealing transaction is, in California, it's described as any transaction between a corporation and a director in which the director has a material financial interest that doesn't satisfy a specific safe harbor. So essentially, any type of transaction is automatically a self-dealing transaction unless certain qualifications are met. And so those qualifications are that the board reviews the transaction and the following facts are established. So in order for a transaction not to be considered a self-dealing transaction, the board has to make a determination without counting the vote of the individual that is interested in the transaction that the corporation acted for its own benefit, not for the benefit of the director, that the transaction was fair and reasonable to the nonprofit. So essentially that means it was no more than fair market value or what would be reasonable for that type of an arrangement. A majority of the board, again, not counting the interested director's vote, must approve the transaction in advance of engaging in that transaction with knowledge of the interested director's interest. And the board also has to engage in a reasonable investigation to make sure that there's no more advantageous arrangement available to the nonprofit. So, for example, if a nonprofit wants to hire a director's accounting firm to provide it with accounting services, that would be a self-dealing transaction unless these facts were established. So if there were other accounting firms out there that would provide the same services for the same price, then the nonprofit would have to look at those other firms and find out which service would be most advantageous to the nonprofit. But if the director's firm was offering, pro bono services or low bono services and providing it with a great deal, and there's no other firm out there that would provide a similar type of a deal, then it would make sense for the organization to engage in that transaction. There are some exclusions to this self-dealing provision. So any action fixing compensation of directors or officers is excluded from the self-dealing provisions. Transactions that are part of the organization's public or charitable programs, as long as, so this came up, I think, in one of the questions about, what if we have a scholarship program? Are my kids, my children, my grandchildren, are they able to participate in the scholarship program because I'm on the board? So this would fall under this exception here. As long as the charitable program did not provide any unjustified favoritism to the director or the director's related individuals, then it would still be permissible. If that person was in a part of the charitable class, essentially that was intended to benefit from that program, that would be an exception. You cannot give special treatment or, consider their relationship to the member of the board in making that determination. But if objectively they would otherwise qualify for those services, they wouldn't be excluded based on this provision here. And then transactions in which the interested director has no actual knowledge and do not exceed the lesser of 1% of the gross receipts of the corporation or $1,000. So those would be accepted from the self-dealing transaction as well. So with mutual benefit corporations that do not hold assets in charitable trust, they do not have to follow that self-dealing transaction section. They have a much more lenient transaction provision here, and this is involving transactions with interested persons. And so essentially the transaction is not void or voidable as long as one of the following apply. So either the members approve the transaction without the vote of an interested person, or the board approves the transaction without the vote of the interested person, and the transaction is considered just and reasonable to the corporation. Or if neither the board nor the members approve the transaction, it still might be okay if whoever's trying to assert the validity of the transaction proves that it was just and reasonable to the corporation. So with the public benefit corporation, it's much more harsh. If the transaction, even if the transaction is just and reasonable to the corporation, if it wasn't approved in advance pursuant to that procedure, it would be considered a self-dealing transaction. In this case, even if it wasn't approved in advance, as long as the transaction is just and reasonable to the corporation, it would not necessarily be a void or voidable contract just by virtue of it involving a director of the corporation. And then this slide discusses transactions between nonprofit corporations that have common directors, which may be the case if there is a yacht club that has a related 501c3 charitable foundation. So transactions between two corporations that have common directors are neither void nor voidable if any of the following applies. So this means that those transactions are permissible if, one, the board or an authorized committee of the board approves the transaction without counting the vote of any of the common directors. That will come into play when we discuss the related entities, because you want to make sure you have enough disinterested directors to approve that transaction. If you have all common directors, then there's no directors that can approve that type of transaction. Or the second is another option. If you can prove that the transaction is just and reasonable to the corporation at the time that it was approved, then it would also be appropriate. Or specifically for mutual benefit corporations only, if the members, being fully informed of the common directorship, approve the transaction in good faith. That's another way that that transaction can be approved as well for membership organizations only. And then another area that differs between public benefit corporations and mutual benefit corporations is whether or not you can provide loans or guarantees to officers or directors. In general, public benefit corporations are prohibited from engaging in loaning money to or guaranteeing obligations of directors and officers. You can do so if you request advance approval from the Attorney General, but I've never seen the Attorney General approve such a thing. So good luck if you do try to request approval. Mutual benefit corporations, however, it is generally permissible unless it's prohibited in the articles or the bylaws. There are a few qualifications. You have to ensure that the loan or guarantee must reasonably be expected to benefit the corporation. And it must be approved by the members or the board without counting the vote of the benefiting director or officer before the transaction is consummated. There are some exceptions for both entities. So advances for reasonably incurred expenses and performing duties, essentially, advances for things that would be permissible reimbursable expenses. Those would be permissible. A loan to purchase an officer's principal residence if it's necessary to retain that officer. So if you need the officer to relocate and they need to purchase a home where they relocate, then you can loan them money to do that. And then advances pursuant to indemnification. So if the organization is permitted to indemnify an officer or director for certain potential liabilities or out-of-pocket expenses and defense costs, then the organization can advance those costs to the officer and director, subject to an undertaking or a bond. And then all of that is extremely important for this particular reason, because if you satisfy your fiduciary duty as a director of a nonprofit organization, you are not liable for any alleged failure to discharge your obligations as a director, except for self-dealing transactions, a little parentheses there. So if you satisfy your fiduciary duties as a director of a nonprofit organization, you cannot be held personally liable for any actions that you take as a director. So that's why it's important to be aware of, and know how to satisfy your fiduciary duties to protect yourself as a director. There is additional protection for volunteer directors of public benefit corporations. This applies to only volunteer directors, so you cannot receive any compensation from the organization, but it provides additional protection for negligent acts that you may engage in the scope of your duties as a director. And there are many exceptions to this. So one of the exceptions is that the organization has to maintain insurance. There are other exceptions, such as this doesn't apply to intentional or reckless actions or actions based on fraud, oppression, or malice. So the justification behind this provision is try to provide incentive to individuals to volunteer as directors of organizations. and not scare people away from serving on boards, which I like to do with my fiduciary duty slides. So directors and officers insurance. So that provision that I just mentioned requires that you maintain insurance. The most common insurance for organizations, nonprofit organizations, is directors and officers insurance. So this will help cover defense costs, settlements, and judgments arising out of lawsuits or allegations for wrongful acts brought against nonprofit officers and directors. Key considerations when choosing an insurance policy, the rating of the company, the duty of the policy to defend officers and directors, a broad definition of claims covered by the policy, and making sure that there's no significant exclusions. Other types of insurance may be required depending on your specific activities. General liability insurance is very common. And then if you have employees, you might need employment protection liability insurance. Cyber insurance is a common one now that a lot of organizations are getting to protect themselves against cyber crimes. If you are engaged in any risky activity involving, children or sailing, I guess in and of itself is inherently a risky activity. If you're going to be engaging in that type of activity that could lead to potential exposure, you'll want to verify with your insurance broker what the appropriate levels of coverage are to protect your organization against those types of claims. And then the Corporations Code does permit corporations to indemnify their directors and officers and other agents of the corporation. It is very technical. It's a very technical statutory provision, so I'm not going to go over the details of it. But one of the key things just to note here is that the right to indemnify is only as good as the financial strength of the organization. So just because the organization can indemnify a director or officer doesn't mean that they have the ability to financially. So keep that in mind when you are fulfilling your duties as a director to make sure that the organization is financially healthy and would be able to protect you if they need to. The power to indemnify does depend on a variety of different factors and usually requires that the board determine that the director or officer that is indemnification satisfies their statutory fiduciary duties to the organization. And the point of these types of provisions are intended to cover all legal threats that are asserted against the director or an officer, which they may be forced to retain their own independent counsel or otherwise might incur expenses in defending. So it's not necessarily to just blanket cover all officers and directors, but to protect them against, out-of-pocket expenses that they might incur just by virtue of being a director or an officer of the corporation and no other reason. All right, so the board in action. So some steps that the board can take to ensure that you satisfy all of your fiduciary duties is hold regular board meetings, make sure that you provide proper notice of the board meetings. There are statutory requirements for providing notice to directors of board meetings. If you don't properly notice meetings, then the meeting itself might not be a valid meeting of the board. So make sure you're aware of what your notice requirements are as specified in the bylaws or as required by the California Corporations Code to make sure that your meetings are properly held and all actions taken therein are valid. The quorum is the minimum number of directors that must be present at a board meeting in order to take board action. Usually it's a majority of the board, but your bylaws may specify a different quorum. Voting, so typically an action of the board requires a vote of a majority of the directors present at the meeting, but there are certain actions that require different types of approvals. Some require a majority of the directors currently in office, as opposed to those just present and voting at the meeting. So make sure you're familiar with what your bylaws require to approve certain board actions. And then minutes. The minutes are, an official record of all decisions made by the board and actions taken by the board, and also document how the board came to that decision. So minutes are a key a key part of being able to show that you satisfied your fiduciary duty as a director, because it'll show what, the board discussed, what actions the board took to approve certain transactions, especially when it comes to those self-dealing transactions, so that you can show to an outside third party that the actions were taken appropriately and that the proper determinations were made so that it wouldn't be considered a self-dealing transaction, for example. And it essentially acts as evidence of the separate existence of the corporation. So in order to maintain that limited liability structure that corporations provide, you have to make sure that the corporation itself maintains a separate legal existence. And the minutes are one of the best ways that you can show that. I wanted to discuss briefly committees. So there are two types of committees of nonprofit corporations. There's the committees of the board, and those are committees that can exercise authority of the board, and they can only be comprised of directors. So that means that, but the board can, the committee itself can exercise board authority as a smaller subset of the board and report back to the board on those actions taken. This is distinct from advisory committees. So advisory committees may include non-directors, but they cannot exercise any authority of the board, and they can only act in an advisory capacity. So it's make sure if you do have committees that you distinguish between which are committees of the board and which are advisory committees, and make sure that the committees aren't engaging in any activity that they cannot legally engage in, including board authority if they're not a committee of the board. And then the key governing documents of the organization to be familiar with and also make sure that comply with the law, not only legal requirements, but best practices applicable to nonprofit corporations that are tax exempt. You have your articles of incorporation. They include a legal statement of purpose. Everything that the organization does has to be stated in that legal statement of purpose. So if you have a very specific statement of purpose, then that means that you can only engage in that specific activity. If you have a more broad statement of purpose, then you may be able to engage in a broader subset of activities. So you want to review your articles of incorporation, your statement of purpose, and make sure that all activities that you're engaging in can be described by that statement of purpose. If not, then you might need to make amendments to your articles of incorporation. Your bylaws essentially restate key provisions of the corporation's code, and they lay out the governance best practices. So there was a question about, our bylaws are overly complicated. Is there anything we can do to simplify them? The short answer is unfortunately not. Because they restate key provisions of the corporation's code, simplifying them does not mean that they don't apply to you. It just means now you don't have it in your bylaws, so you're not aware that it applies to you. So the bylaws tend to be a very comprehensive document. There are ways you can customize the bylaws to your organization, but there are a lot of ways that you cannot. So when it comes to those self-dealing provisions, like I mentioned above, those are the law, and so they should be restated in your bylaws so you have to follow that. If you remove them from your bylaws because it seems overly complicated and you don't, want to have to adhere to that, that doesn't necessarily remove that requirement from your organization. It just makes it so that the board is not aware of that requirement and is more likely not to follow that requirement. So we typically don't recommend simplifying bylaws. We do recommend keeping them comprehensive so that anytime the board has any question about what laws are applicable to it, it can refer to those bylaws and get the answer. It's also important to review those bylaws regularly to make sure, not only that it complies with the law, but two, that it complies with your own practices. So if your bylaws say, we need to meet quarterly and you're only meeting every other or twice a year, then you're not in compliance with your bylaws. If you're not in compliance with your bylaws, then actions taken by the board can arguably be invalidated. So it's always important to make sure that you're adhering to your own organizational bylaws. And if you're not, make the necessary amendments to ensure that you do. Otherwise, you could risk having invalidated corporate actions. And then there are key governance policies that you want to make sure you have in place. The main three that you report to the IRS, or the IRS asks if you have, are the conflict of interest policy, the whistleblower policy, and the document retention policy. I would say at a very minimum, you need to have a conflict of interest policy. The whistleblower policy, may or may not be appropriate if you don't have employees, or, it may not make sense to have a whistleblower policy. The document retention policy, I would say, is secondarily important to the conflict of interest policy, just so you know when you have to hold on to documents and when is an appropriate time to dispose of documents. And then we have regulatory compliance. So one of the things I mentioned in the duty of obedience was being aware of what your annual filing requirements are to ensure that you stay up to date with your filings and with legal requirements imposed upon your organization. So with nonprofit tax-exempt organizations, there are typically 3 or 4 regulatory bodies that you have to be aware of. There's the Internal Revenue Service. You have to file annual information returns, which is that Form 990. There's the state taxing agency. In California, we have state income tax, so you have to file an annual information return with the Franchise Tax Board. There's the Secretary of State, and that's the organization that you are legally incorporated by. So every 2 years, you have to file a statement of information, updating them on your officer's information and your agent for service of process. And then for charitable organizations, there's the Attorney General. So California nonprofit public benefit corporations are required to register with the Attorney General's Registry of Charities and Fundraisers and annually file registration renewal reports. Mutual benefit corporations generally do not have to file unless they hold assets in charitable trust. So if you hold any assets in charitable trust as a mutual benefit corporation, then you are legally required to register and submit those annual renewal reports. It's important to maintain good standing with all of these agencies. If you become delinquent with one, you could become delinquent with others. So for example, if you lose your internal revenue tax exempt status, you lose your state tax exempt status. If you lose your registration with the Attorney General's office, you could lose your tax exempt status with the Franchise Tax Board. And if you lose your status with the Franchise Tax Board, you could become suspended with the Secretary of State. So all of them are interconnected, so it's important to maintain good standing with each of the agencies. Not only can you become delinquent or suspended, which would impair your ability to do business in California and to expend assets in California, but you could also be subject to audits from the IRS or the Attorney General's office or the Franchise Tax Board, and you could also be subject to taxes and penalties imposed upon your organization. So all good reasons to ensure compliance with all of those regulatory agencies. And then with regards to organizations that hold assets in charitable trust, it's important to properly manage those charitable assets. So responsible fiscal management of charitable assets includes maintaining adequate and correct financial records and obtaining independent audits if required. So in California, if you hold charitable assets and you have income in excess of $2 million in any given year, you're required to obtain an independent audit. So that's a specific requirement on charitable organizations. Charitable assets are always required to be used for the purposes for which they were given or solicited. So what that means is if you hold a fundraiser and you say, we're raising funds for scholarships, and you raise, funds for during that fundraiser, all of those funds raised during that fundraiser have to be used for scholarships. You cannot divert funds to other purposes, for administrative expenses, for other charitable programs. They have to be used for that purpose that you told the donors that they would be used for. And then, as I mentioned, charity registrations. So if you are going to be holding charitable assets, you're required to register and file renewal registration reports with the Registry of Charities and Fundraisers, regardless of whether or not you are a charitable organization. Okay, so we've gone through all of the California specific stuff, and so now I want to dive a little bit into the federal tax exempt status. So this is the 501c3 versus the 501c7. So 501c3 is any organization that is operated exclusively for religious, charitable, scientific, etc. purposes. There's a long list that is included in there. No part of the net earnings of which inures to the benefit of any private individual. No substantial parts of which include carrying on propaganda or otherwise attempting to influence legislation, otherwise known as lobbying, and which does not participate in or intervene in any political campaign on behalf of any candidate for public office. So you can see there's a lot of limitations in this paragraph on what 501c3 organizations can do. Now, in contrast, we have 501c7. This is an organization that is organized for pleasure, recreation, and other non-profitable purposes. Substantially all of the activities of which are for such purposes and no part of the net earnings of which inures to the benefit of any private shareholder. So much less limitation on 501c3 activity, but you'll see it does still include that provision about no private benefit to any individual. So we'll talk about what that means here in a minute. So what are the advantages of tax-exempt status? Why apply for tax-exempt status? Well, one, for both 501c3s and 501c7s, you're exempt from state and federal corporate income tax on income directly related to furthering your exempt activities. So we'll get to that. For 501c3s, you're exempt from federal unemployment tax. For 501c3s, you're eligible for property tax exemption if you're holding property for charitable purposes. For 501c3s, you're eligible to receive grants from the government, from foundations. And for 501c3s, contributions to the organization are tax deductible to the contributor. So that's the main kind of difference between 501c3 and 501c7. Now, of course, there are disadvantages to operating as a 501c3, and that's stricter restrictions on activities. Like I mentioned, all those restrictions that were included in that paragraph. There's less things that you can do with those charitable assets. You're subject to, as I mentioned earlier, Attorney General registration and oversight. Increased transparency and reporting requirements. So you're required to disclose more information to the general public about your activities and your use of assets. And I touched on this briefly at the top of the presentation, but for public charities, you must meet the public support test, which means that you need to get a specific percentage of your funds, your income, from the general public or from activities that are income generated from activities that further your exempt purpose. So the public support test is kind of in and of itself a complex area of law, but typically kind of means that about at least a third of your income has to come from general donations from the general public. So what is the process for forming a nonprofit corporation with 501c3 status? So a lot of the yacht clubs were interested in learning about forming a 501c3 or what that would look like. So essentially you would form a nonprofit corporation, which in California is a public benefit corporation. You would draft your bylaws and appoint the initial board and officers, hold your organizational meeting where you decide on the purpose and the mission of the organization and how the organization is going to fulfill that purpose and mission, decide on budgeting and things like that. Obtain 501c3 federal exempt status. So that is obtained by filing an exemption application or a Form 1023. And this is where you explain to the IRS what your purpose is, what your activities are, and generally why you qualify for 501c3 status. Register with the Registry of Charities and Fundraisers. Obtain California state tax exemption. So in California, as I mentioned, since we have state income tax, you would separately have to apply for tax exemption at the state level. If you get federal tax exempt status, you get automatically state tax exempt status, but you have to file for it. So you can attach a copy of your exemption letter from the IRS and submit that to the FTB, and they will automatically exempt your organization under state law as well. And then obtain any additional state or local exemptions or permits like business licenses or solicitation registrations in the county or the city in which you're going to be operating in as needed. So key decisions, of course, in forming a nonprofit corporation are deciding what the name of the organization is going to be, what the purpose is going to be, the appropriate legal form. So like I said, in California, that would be the Public Benefit Corporation, and the state of incorporation. So if you are interested in incorporating outside of the state of California, there might be different requirements to follow. And then drafting the bylaws, you want to think about the type of governance structure you want to impose, whether or not there's going to be a voting membership or a self-sustaining board. Like I mentioned before, C7 social clubs are required to have a membership, but C3 charitable organizations are not. So you want to consider whether or not it makes sense to have a membership organization or not. And if you do have that membership, you have the additional administrative burdens that we discussed above, requiring membership approval of certain actions. You'll need to decide upon your officer structure and, of course, the meeting frequency and format. So how often you're going to meet as a board, whether or not you're going to have any committees and who's going to be on those committees, who's going to serve in specific officer roles. So to qualify as a 501c3 organization, you have to be organized for one or more exempt purposes. So this is that list that I was talking about before: religious, charitable, scientific, testing for public safety, literary, educational, or prevention of cruelty to children or animals. So if you fall under one of those categories, you would qualify for exemption as a 501c3, but only if all of your activities or substantially all of your activities are directly in furtherance of those activities. So what that means is no more than an insubstantial part of your activities can be in furtherance of no more than an insubstantial part of your activities cannot be in furtherance of your tax exempt purpose. And the organization as a whole must serve a public rather than a private interest. So the two most common tax-exempt purposes of a 501c3 organization are charitable and educational. So charitable, I kind of listed what qualifies as charitable here. We don't need to go through it specifically. And then educational instruction or training of individuals or the public on subjects useful to the individual and beneficial to the community. So as long as the organization is engaged in charitable or educational activities that fall under these definitions, then the organization would qualify as a 501c3 charitable or educational organization. And then to contrast 501c3(7) status, in order to qualify as a tax-exempt social club under Internal Revenue Code 501c7, an organization must be formed as a nonprofit corporation, and it has to satisfy certain organizational and operational requirements. A club must have an established membership of individuals. So I mentioned that was one of the main differences between membership and non-membership organizations is the social clubs are required to have a membership. A mingling of the members must play a material part in the life of the organization. And then the members must actively share interests or goals. So not as many qualifications as 501c3 status. And then maintaining tax-exempt status. So once an organization qualifies for tax-exempt status, applies for tax-exempt status, and is granted its tax-exempt status, there are a variety of different ways that you can go about losing that tax-exempt status. So one is engaging in more than an insubstantial amount of activities that are outside of your exempt purpose, and that includes commercial activity. So commercial activity or business activity is a very common way for organizations to lose their tax-exempt status is by engaging in too much business activity. Providing a private benefit or annulment. Both of those provisions, 501c3 and 501c7, reference this not providing, not inuring to the private benefit of any individual. So this concept of private benefit and private annulment is really important for both 501c3 and 501c7 organizations. Engaging in impermissible lobbying or political campaign activity is specific to 501c3s. That was specifically mentioned in the 501c3 code section. as a limitation for charitable organizations. But note that the first bullet point still applies to 501c7s in that if it is engaging in lobbying activity or political campaign activity that does not directly further its exempt purpose, that could be, and it's more than an insubstantial amount of what it does, that could be a reason that it loses its tax-exempt status. But there's no direct prohibition on 501c37s engaging in that type of activity. And then the most common way that organizations lose their tax-exempt status is by failing to file required returns. An organization that fails to file 3 years of returns in a row is automatically revoked, automatically loses its tax-exempt status, and it would be required to reapply for tax-exempt status and re-go through the process of obtaining that tax-exempt status. So back to this concept of private benefit, because this is a big concept for both 501c3s and 501c7s. This phrase, no part of the net earnings may inure to the benefit of any private shareholder or individual. So what that means essentially for charitable organizations, for 501c3s, the activities must benefit the public. And for 501c7s, that means that the activities must benefit the members of the social club. Private benefit may be incidental. What this means is that if you benefit as an individual from the activities of the organization by virtue of the organization carrying out its charitable or social club activities, that's fine. It just cannot be a directed benefit towards you as an individual that is related to the organization or unrelated to the organization. So for an example, if an organization has a program that provides financial relief to individuals who were affected by a wildfire, for example, and I was a member of that class and I received relief as a part of that charitable program, that would be an incidental private benefit, a benefit just by virtue of me being part of that charitable class that program was intended to benefit. But a nonprofit corporation, if I was on the board of a nonprofit corporation or related to somebody that was on the board of a nonprofit corporation, and they heard that I had been affected by a wildfire, and they said, let's start a program where we give Kristen financial relief for all the stress that she was caused by the wildfire she was involved in. That would be a private benefit directed at me, and that would be inappropriate, an inappropriate use of charitable assets. So that's kind of the difference between a private benefit being incidental and it being a private benefit that would not be allowable under the provisions of the Internal Revenue Code. So the best way to avoid private benefit is having objective criteria for determining who receives benefits. So having that wildfire relief program where there's objective criteria for how you would apply. You've been affected by a wildfire, you have, your income is below the median income, you live in this particular area, any objective criteria that you can list. If someone qualifies for the program because they satisfy those objective criteria, then they would qualify for the relief provided. Not using subjective criteria. So not looking at the applicants that apply and saying, oh, she's the daughter of someone on our board, we should give her the relief. You can't look at those types of subjective things in order to make your determination. It has to be on objective criteria only. And then this concept of private inurement is just a subset of private benefit that involves insiders. So directors, officers, substantial contributors to the organization, or essentially anyone that has influence over the organization in one way, shape, or another. And then the best way to help ensure you avoid private inurement, private benefit to insiders, is by having that conflict of interest policy and making sure that all officers and directors are at least annually disclosing any potential conflicts of interest so the board can review them and ensure that they're not providing an impermissible private benefit. Another common example of a private benefit is excess benefit transactions. So when it comes to executive compensation, for example, if a nonprofit decides to pay an executive salary that is higher than what would be considered reasonable for the services provided, Any amount over what is considered reasonable would be excess benefit, and that's a form of private benefit, and that is taxable to the organization. So if the organization is determined to be providing an excess benefit transaction, it could be taxed on the excess benefit provided to the individual, and the individual that receives the benefit can also be taxed on the excess benefit received. So it's important from both sides of the equation to ensure that the organization is not engaged in private benefit or excess benefit transactions to avoid liability on both the individual receiving the benefit as well as the organization providing the benefit. In addition to that, any directors that approved the excess benefit transaction can also be held liable, and they impose an excise tax on them as well. So as a director of the organization, you also want to make sure you're approving transactions appropriately and not approving any transactions that might be considered an excess benefit transaction. It's a very, very important area of the tax code. So for specifically 501c3 organizations, I mentioned this lobbying and political activity limitation. Essentially what it means is that no substantial part of the organization's activities can be lobbying, which is directly attempting to influence legislation. Sometimes this is confused with issue advocacy. Nonprofits can engage in issue advocacy. They can advocate for issues that help support the exempt purpose of the organization. But to the extent that that issue advocacy directly targets active legislation or some bills that are being voted upon, that could be considered lobbying. And that's where you need to make sure that the organization is not engaged in a substantial amount of lobbying. But what does substantial mean? And of course, the IRS does not have a definition for this. It's a very gray area. In some cases, it could mean 5% of time devoted to lobbying activities or 20% of time devoted to lobbying activities, but it takes into account everything: time, expenses, even if it's volunteer time, or no money is spent on it, that could still be considered substantial lobbying. So it's a very gray area, very facts and circumstances determined. So there is an ability to elect to be bound by an objective standard. It's called the 501H election. And essentially, I'll go to that in the next slide. Before I go into the 501H election, just a note that political campaign intervention, which means either participating in or intervening in any political campaign on behalf of a candidate for public office, whether vocally supporting or opposing or monetarily supporting a candidate for public office, is completely prohibited for 501c3 organizations, cannot engage in any of that activity. But for lobbying, if you decide to elect to be bound by a 501H, it provides an objective test to determine whether or not you're engaged in a substantial amount of lobbying. And the objective test is just based on expenditures. So essentially, as long as your expenditures don't exceed between 5 and 20% of your exempt purpose expenditures, you will be within permissible limits for lobbying. So organizations that do engage in lobbying are oftentimes, should elect to be bound by this test so that they can be guaranteed that they're not engaged in a substantial amount of lobbying. Whereas if you rely on that subjective substantial part test, then it is possible that if you engage in a decent amount of lobbying, that you could be considered in violation of that requirement and ultimately lose your tax-exempt status. For 501c7 organizations, there is a limitation on where your source of income, essentially, the investment income limitation. So 501c7 organizations are able to receive income from sources other than their members. So that means income from investments or income from non-members for using facilities or services. But there is a limitation on the amount of income that can be derived from non-members, including investment income. So this is also a kind of substantial test that the IRS imposes on organizations which is not clearly defined. So the IRS has created this safe harbor guideline, which essentially means if you fall within this safe harbor, we're going to say that it's not substantial and you're in the clear. If you don't fall within this safe harbor, then that facts and circumstances gray area test applies, and they would look at all of the organization's activities to make a determination on whether or not it would warrant loss of tax-exempt status. So the safe harbor essentially says that a social club can receive up to 35% of its gross receipts, including investment income, from sources outside of its membership without losing tax-exempt status. Within that 35%, no more than 15% can be derived from the public for use of the social club's facilities or services. So there's two limitations there to be aware of if you are deriving income from sources other than your members. And this kind of pivots us into unrelated business taxable income. So another way that an organization can lose its tax-exempt status is by engaging in too much business activity that does not directly further the organization's exempt purpose. So that type of activity, accepting fees from the public for use of facilities, is a type of unrelated business activity. For 501c3s, it's also important to make sure that you don't engage in a substantial amount of unrelated business activity. It's any activity regularly carried on for the production of income that does not directly further the exempt purpose of the organization. So the example I like to use for 501c3 organizations would be like selling t-shirts. So if an organization sells t-shirts regularly throughout the year, has a button on its website where you can buy a t-shirt, that's going to be unrelated business activity because that does not directly further the exempt purpose of the charity. It's just to produce income. And it might be a good fundraising, strategy to bring in additional income for the organization, but the activity itself doesn't directly further the organization's activity. But on the other hand, if they just have one event a year where they sell t-shirts and they raise money for a fundraiser, that wouldn't be considered unrelated business activity because it's not regularly carried on. So that's kind of an example of a type of unrelated business activity that might be engaged in by a charitable organization. Net income that is generated from an unrelated business activity is taxable at the current corporate income tax rates. I put an asterisk here because the way that unrelated business taxable income is calculated is different for 501c7s. So for 501c7s, unrelated business taxable income is essentially any gross income excluding exempt function income, less any deductions allowed for that business activity, which is directly connected with the production of that gross income. So anything other than your exempt function income, which would be income from your members essentially, is considered unrelated business taxable income for 501c7s. Whereas for 501c3s, it is just net income generated from unrelated business activity. The key difference there is that the exceptions. So one of the exceptions for 501c3s for unrelated business taxable activity is passive investment income. So as long as the organization is not actively engaged in the investment itself, that is excluded from unrelated business taxable income for 501c3 organizations. But for 501c7s, since it's not exempt activity income, it would not be excluded from unrelated business taxable income, and it is taxable to 501c7 organizations. So that's the key difference between C3s and C7s when it comes to unrelated business taxable income. Unrelated business taxable income must be reported annually on Form 990T. That's in addition to the Form 990 that has to be filed for each exempt organization. So when we talk about related 501c3 and 501c7 organizations, there's a few key principles to keep in mind. One, the C3 cannot be controlled by the C7. The C3 has to have an independent board of directors that makes decisions in the best interests of the C3. Now, there might be overlap on the boards like we discussed above with common directors, but remember, if there is overlap, that the directors, when they're on the board making decisions for the C3, they're making decisions in the best interest of the C3 without taking into account the interests of the C7 and vice versa. When you're on the board of the C7 and making decisions for the benefit of the C7, you have to make decisions in the best interest of the C7 without taking into account the interests of the C3. So it's important that you wear different hats when you're sitting on the boards of the different organizations. And there has to be independence for the C3 to be controlled separately. The C3 cannot do anything to the benefit of the C7. It cannot further the C7's exempt purpose at all. It can work with the C7 to further the C3's charitable activities. So if the C7 is otherwise engaged in activities that would be permissible to be engaged in by the C3, educational activities, for example, then the C3 can work with the C7 on those activities and can use the charitable assets to benefit those activities of the C7. But it has to be extremely limited to activities that the C3 would be able to engage in independently. It cannot use its C3 funds to fund C7 activities. They may share resources, office space, and/or employees, and often do, to help keep costs down. But the C7 has to pay fair market value for usage of C3's individuals, resources, or services. So you want to have a cost sharing agreement in place that clearly defines how those costs are shared and making sure that the organizations are each paying their fair share of those resources, services, or employees. It's always important to have a written agreement in place for any coordination of activities or resource sharing between the entities, just to make sure that you're not using charitable assets for impermissible purposes and vice versa with C7 assets as well. So those are key things to keep in mind when you have a related C3 and C7 organization. And then just 2 more slides to go over kind of like a summary of all of the things that we discussed. So common mistakes that we see with organizations fall into one of these categories essentially. So corporate governance, meaning, not adhering to your fiduciary duties as a director, not adhering to your bylaws, engaging in activities that are outside of the purposes that are specified in your articles of incorporation. Regulatory compliance, meaning not filing your annual information returns or otherwise abiding by regulatory requirements for 501(c)(3)s or C7s or nonprofit corporations in general. Improper use or waste of assets, engaging in activities outside of your tax-exempt purpose, engaging in substantial amount of commercial activity, private and benefit and enrichment, engaging in impermissible political activity or lobbying activity. Notice requirements for sales and transfers of assets. I didn't address this specifically, but for organizations that hold charitable assets, you are required to notify the Attorney General's office anytime you dispose of a substantial amount of assets or anytime you merge with another entity or dissolve your organization. So those are all things that require notice to be provided. And then substantiation and disclosure. So as a 501(c)(3) organization, you have to make sure that you substantiate donations, that you disclose information that's required to be disclosed by law, such as your Forms 990, your exemption applications, your determination letters. And then, of course, documenting all transactions and decisions made by the board, whether or not it's of the C3 or the C7, but maintaining that documentation in meeting minutes or other written forms to make sure that you can show that actions were taken appropriately. And tips for avoiding these common mistakes: hold your required board meetings and take those minutes. So document those actions. Make sure you are properly registered with the required regulatory authorities and you're submitting your annual filings regularly. Maintain proper accounting procedures and records. review and modify existing corporate documents as needed. So like I said, with those bylaws, if you're not following the procedures that are specified in your bylaws, make sure you update your bylaws to ensure that you do, and make sure that they align with corporations code and laws applicable to California corporations. For charitable corporations, applying for property tax exemption if it's applicable. If you own property and you use that property for charitable purposes, you may be exempt from property taxes. Providing proper notice for asset sales and transfers and other business transactions. Reporting proper commercial activities and paying that unrelated business income tax on taxable income. And then, of course, avoiding the provision of private benefit to any individuals other than incidental private benefit. And that is all I have for you today. I know that was a lot of information. So if anyone has any questions, I would love to answer questions.
Well, thank you so much, Kristen. As people think about the questions they may have, I just want to encourage you all to use the chat to put any questions you have, and just know there are no dumb questions here. If you're thinking of it, it's likely someone else is probably thinking of it too. So just go ahead and put that in chat. Kristen, thank you so much. That was a lot of information, and I took quite a bit of copious notes myself. I have several questions, but one just to kick things off. So going back to sort of distinguish between fundraising and sponsorships. So many of our organizations hold events. Some are events that I think probably would be characterized more as fundraising because you're fundraising for example, we have Marine Mammal Care Center. That's an organization that is in our SoCal or our broader community even, that a lot of our organizations will maybe have a fundraising event once a year and earmark funds for that. So I was thinking that's kind of like an example of a fundraising event. But sometimes we have regattas, for example, or women's conferences that are directly connected to our purpose. And we go for sponsorships to help defray the cost of those events that are directly connected to our purpose. So would those sponsorship dollars be considered LBTI?
UBTI,
I mean,
unrelated business
UBTI.
taxable income. Um, Not necessarily. So first and foremost, Marine Mammal Care Center, wonderful organization. I've worked with them before, so I'm glad to hear that some of you some of your clubs are supporting that organization. I want to address that first, and then I will come back to sponsorships because
Okay.
if your organization is soliciting donations for a charity or for a charitable purpose, that is considered solicitation. And so your organization would be required to register with the Attorney General's office and report on that activity. So it depends on how that activity is being held. If you're just saying, we like to support Marine Mammal Care Center, click here to donate, then that might not be considered solicitation of charitable assets because you're just telling them to donate to another organization and they're donating directly to that organization. But if you're saying, come to our event, any money you give to us for this event is going to go to Marine Mammal Care Center, you are soliciting and holding charitable assets in trust. And you are legally obligated to turn those assets over to the charitable organization that you solicited them for. That's what creates that registration and reporting requirement. So just wanted to make sure that's clear. If any 501c7 organization is engaging in that type of activity, please, discuss with counsel whether or not you're required to register and report on that solicitation activity. When it comes to the sponsorships, it depends on what the sponsorships are for. So, it's possible that it could be unrelated business taxable income, um, if it is not directly in furtherance of the exempt activity of the organization. Um, I don't know how those are being solicited or what the sponsorship agreements say, so I can't say whether or not they are or aren't, but I would say it could be either or, depending on how it is structured.
Okay, thank you.
Mhm.
Okay, so we do have, great, some other people have jumped in, so I'm gonna read them to you. If a public benefit corporation does not have well-worded formation documents, can those documents be cured, make them more appropriate for the exempt organization's purpose?
Yes, absolutely. We come across this quite frequently where we do a compliance review for a new client and we see that their formation documents, are not appropriately stating their tax exempt purpose or don't include the limitations that are required to be included by the Internal Revenue Service. So you can restate your articles of incorporation, or amend them and put in the correct provisions, or amend the statement of purpose of the organization to more accurately describe its activities.
Okay, we have another one. We have a C3 sailing foundation that is loosely connected to our C7 and share boat resources. What are the points to watch out for?
Yeah, so the key considerations when you have a C3 and related C7 are ensuring that you're not using any charitable assets for non-charitable purposes. So you can't use the C3 assets to provide a benefit to the C7 or any property owned by the C7 or to any members of the C7. So to the extent that the C3, the activities help further the C3's purpose, whether it's educational or charitable, you can use the C3 assets on that activity. But for example, if you own a clubhouse, say the C7 owns a clubhouse and it needs to renovate a room in the clubhouse, you can't use C3 activity or funds to renovate a room in the clubhouse, for example. That would be an example of what would be considered impermissible.
Okay, great. Thank you. Okay, next question. We struggle with members, C7, wearing political hats and clothing. I believe a private club may limit free speech, but is that correct? And if so, are there limits to that control?
I do not have an answer for you because I am not a constitutional attorney and I'm not an expert in free speech. So I don't know what the answer is to that. I apologize.
So I've heard other people ask a similar version of this question. So a 501c7 social club, for example, um, whose purpose is specific to sailing and education and safety on the water. If people are wearing political hats and clothing in the club or flying political flags alongside the burgee of the club, is there anything around that that would be political or
I
problematic?
I don't know. All I know is that for 501(c)(3) organizations, the free speech part I don't know about. What I know about is what is permissible to be engaged in by a 501(c)(3) or 501(c)(7) organization. 501(c)(3) organizations cannot engage in any political campaign intervention. So what that means is, if you are a director of a 501(c)(3) and you are speaking on behalf of that 501(c)(3), you cannot in basically imply support or opposition to a candidate for public office. So if that the thing that you're wearing implies support for or against a political or an individual that is running for public office, that would be inappropriate. But as an individual, you can do whatever you want. So if you personally support or oppose a candidate for public office, as long as it's clear that you're not doing so as a representative of the nonprofit that you are a director or officer of, there's no limitation on that activity from a nonprofit law perspective. I
Okay.
don't know the free speech, like what you can limit your members from saying or doing when they're in your private clubhouse. I just don't know the free speech rules and regulations around that.
Okay. So it sounds like it's limited to officers of the club.
Only if they're speaking on behalf of the nonprofit. If
Um,
they're speaking in their individual capacity, they can say whatever they
I
want
won't. Okay.
from a political perspective. But if they're at a fundraiser and they say, "I'm the director of XYZ Yachting Foundation and I support this candidate for public office," that would be inappropriate. But if they are on their own going to a rally or some sort of event for a public officer, that would be perfectly fine because that's in their individual capacity.
Okay. All right. Thank you. Okay, so another question. A boat or vehicle was donated to a C3. The C3 wants to sell this asset to have funds for other C3 charitable activities. Does this sale require special reporting?
So it depends. If you're selling it to an interested person, so that would be to someone who's on the board, or otherwise related to the organization, then you would have to follow the self-dealing transactions that we discussed in the presentation. If it's sold to someone completely unrelated, then you just need to make sure that it's fair and reasonable to the nonprofit, sold for fair market value, that the individual who's purchasing the boat is essentially not getting a private benefit out of that purchase.
Okay.
Oh, and one more
Um,
one more consideration. If the value of the boat is substantially all of the assets of the organization, if it is 75% or more of the value of all its assets, that would need to be reported to the Attorney General's office as well.
And if I recall, then and the membership would need to also approve it, right? Because
Yeah,
if it's substantial.
if there's a membership, yeah. So since it's the C3, I don't know if there's a membership, but if there was a membership, they would also need to approve it if it was a substantial disposition of assets. Yeah.
All right, thank you. So for C7 organization, passive income needs to be reported as taxable profit, or is there an exemption amount, or is that only for 501c3s?
For 501(c)(7)s, yes, income is unrelated business taxable income. Unrelated business taxable income can be offset by expenses related to other income, unrelated business taxable income. So you'll be able to use traditional business deductions to offset that income, and you would only be paying taxes on the net income derived.
Okay.
That's
So
just for 501(c)(7)s. Passive income for 501(c)(3)s is excluded from unrelated business activity
and
or
an
income.
example, for example, of passive income, we have invested certain amount of money into SCD. So
Hmm.
that would be considered um, passive income that does not fall under the UBTI, unrelated
For,
business.
for the C3, correct,
For
yes.
for the C7?
No, for the C7, all passive income is unrelated business taxable income. Yeah. It's
All
not
right.
that exception doesn't apply to C7s.
Okay. All right. So can the 501c3 funds promote sailing competition for a number of individual youth sailors by supporting about 5% of the event costs? Some are supported by scholarships.
Yeah, if the event itself that the C3 is contributing to directly furthers the charitable purposes of the C3, which would be fostering, amateur youth sports, then you can use C3 funds to support that event.
All right. Thank you. Next question. If a board committee includes at-large member, can they still operate with board authority?
Um, it depends on what you mean by at-large member. If you're talking about just any member of the board, then yes. So a board committee of the board, as long as it's comprised of only board members, whether they're officers or at-large directors, that would be considered a committee of the board that could be delegated board authority. If there is a non-director on a committee, then that's an advisory committee, and that committee cannot exercise any authority of the board.
Something related to windfall contribution. If it is a lot, what needs to be done?
I'm not sure I understand what the question is.
Yeah, Paul, maybe you can rephrase it and put it into the chat. I have a question about a board committee. So many of our clubs have a nominating committee, and the purpose of that nominating committee, more or less, is to identify and some recruit, some tap on shoulders of people that they recruit for the board of
Mhm.
directors, and including officer positions like treasurer and secretary. Some of these nominating committees are made up of um, staff commodores who may not be current board of directors.
Mhm.
Some of the nominating committee structure that I've seen includes current board members, or a mix of a staff commodore, a director, and and regular member. Um, and in some cases, the nomination is put forward like, here's the slate of officers without alternatives. So it's more like
Mhm.
when it goes to the membership, it's more like it's a confirmation rather than a
Right.
true vote. So that was a gray area that I didn't see in your presentation about that process. And so I guess my question is, as long as it's outlined clearly in the bylaws, um, is that fine?
Yeah,
Mhm.
as long as there, so are you talking about for the C7 or the C3 or both?
C7, C7.
C7.
Hmm.
Yeah. As long as if the members have the right to vote on the election of the directors, as long as they vote, they have that vote, whether or not it's, these are the directors, you vote yes or no, they have the ability to approve the election of directors, that's fine. The nomination procedures just have to be reasonable, excuse me, just have to be reasonable and set forth in the bylaws. That's a very common way to handle director elections. Is to have like a slate presented to the members and then they say yes or no. So they still have the ability to elect the directors even though it's a slate presented. Yeah, that's perfectly
Then that's
fine.
fine. Okay,
Yep.
so there was clarification on the last question. If a 501(c)(3) receives $500,000 from an individual and generally earns only $100,000 annually, is there additional responsibilities, I think, relating to reporting if they do not want their name exposed? Oh, if they do not want their name exposed. The donor does
Um,
not want their name exposed.
the donor doesn't want their name exposed. The donor's name won't necessarily be exposed. Paul, would you unmute? Maybe clarify. I don't know if I understand.
Yeah, that's fine. No,
Yeah,
thank you. By the way, thank you so much for what you gave us tonight. It's absolutely
of
fantastic.
course. Of course.
Um, we have the prospect of receiving an unusual amount of money based
Uh-huh.
on our normal receipts. And the person probably doesn't want it, he wants it anonymous. And I just wanted to, you mentioned something earlier in your presentation that if we had a large amount of money donated by that was unusual, that we'd have some additional reporting. I'm not sure what I need to do.
I see, I see. Okay. So there's a couple different implications behind this donation, and so I'll talk about both of them. One is if the $500,000 would tip you out of the private public charity classification, that could be a problem. So what I mentioned earlier was in order to maintain your public charity status, you need to have public support, which means that about a third of your income has to come from the general public and not from one or a large, a small group of individuals. So when I see a large donation like that, my first concern is that going to affect your public support and affect your status as a public charity? If it does, and that's just a one-time donation, it's an unusual grant, then the IRS has an exclusion for unusual grants. And if you can make a case that it's an unusual grant, it won't negatively affect your public support test, and you will still be classified as a public charity. So that's one consideration that I would just keep in mind with a large donation like that. The other is you do report donors on your 990, but it's on something called a Schedule B, and the Schedule B is not publicly disclosable. So you don't have to disclose the public B to the general public. If someone were to ask for a copy of your 990, you don't have to report it to the Attorney General's office either. You can exclude your Schedule B. So the donor's name should not show up on your publicly reported documents if that's a concern with regard to the donor.
Thank you very much.
Yeah.
All right, we have another question. If a C7 receives a state asset from a deceased member in excess of 35% of our total annual income, is it taxed as ordinary income?
It's possible. Without knowing all of the facts and circumstances, I can't say for certain whether or not it would be, but it is possible. I would definitely recommend reaching out to counsel if you were going to receive a bequest like that to make sure it doesn't negatively affect your tax-exempt status.
All right. Are there any other questions? All right, well, seeing as there are no other questions coming through, Kristen, I just want to say thank you again on behalf of Southern California Yacht Club members, and thank you to everyone who came to learn more. We're so grateful for your time and your wisdom that you shared with us this evening. And just thank you so much. And for everyone who's still on the line, we will be sending out the copy of the presentation and the recording most likely tomorrow at this point. Kristen, thank you so much. Thank you for being with us this evening.
Yeah, thank you all for having me. I hope it was useful and informative.